Stop listening to the soft landing narrative. It is a financial death trap. The raw data proves Florida has officially entered a phase 2 collapse, and the numbers are catastrophic. Statewide home values down 5.3%. Charlotte County plunging 13%. Punta Gorda condos crashed 18.6%. We are drowning in a 10-year inventory record of 163,059 unsold homes, while nearly 44% of desperate sellers are slashing prices just to beg for an exit. And the most terrifying metric of all, Florida has just become the absolute #1 foreclosure capital of America. This isn't a market cycle. It is a systemic failure fueled by an insurance crisis and a mass investor exodus. Before you spend a single dollar in 2026, you need to see exactly who is already trapped inside. If you listen to the talking heads on cable news or read the glossy reports from Fortune magazine, they are desperate to sell you a very specific story. They use comforting words like normalization, middle ground, or a healthy reset. They tell you that inventory tightening will hand leverage back to sellers. It is a carefully constructed narrative designed to keep you calm. But if you look at the raw data coming out of the Florida housing market as we enter 2026, you realize that this narrative is not just wrong, it is dangerous. We are not witnessing a reset. We are witnessing a valuation freefall. For the first time since the great financial crisis, the bedrock of Florida's real estate wealth is cracking. Verified data confirms that statewide home values have officially dropped by 5.3% year over year as of November 2025. This isn't a rounding error. This is billions of dollars in perceived equity evaporating into thin air. And unlike the correction of late 2022, which was a temporary reaction to interest rates, this decline is structural. It is the sound of a bubble popping in slow motion. While the mainstream media distracts you with averages, the true carnage is happening in the crash zones. Look at Charlotte County. This isn't a softening. It is a demolition. Home values there have collapsed by 13.0% in a single year. In Lee County, home to Cape Coral and Fort Myers, the former darlings of the pandemic boom, values are down 10.6%. These double-digit declines are the red flags that the industry is trying to hide from you. They signal that the Phase 2 crash is no longer a prediction. It is here. The catalyst for this implosion is a massive, unprecedented flood of supply. For over a decade, we were told there was a housing shortage. That lie has now been exposed. In November 2025, active listings in Florida surged to 163,059, the highest level recorded in 10 years. Think about what that number represents. It represents over 160,000 homeowners who are trying to exit the market simultaneously, only to find that the door is shut. The time to contract in places like Lee County has exploded by 50%, stretching to nearly 2 months. Liquidity is drying up. Sellers are no longer negotiating. They are capitulating. The desperation is palpable in the data. Nearly 44% of all listings in Florida had to slash their asking prices in November just to get a showing. The gap between what sellers think their homes are worth and what the market will actually pay has become a chasm. In Charlotte County, homes are selling for nearly 5% below their list price, proving that the sellers have lost all leverage. And for those who bought at the peak, the consequences are catastrophic. Let's look at the anatomy of a bad investment. Take this property in Central Florida. The owner bought it at the height of the hysteria. In 2022, for $364,000, they believed the hype. They believe prices only go up. Fast forward to 2025. That same house was sold at a foreclosure auction for $224,000. That is a 39% haircut. That is not a paper loss. That is $140,000 of real wealth destroyed. This is the reality of the buyer's market in 2026. It isn't a discount store where you pick up bargains. It is a graveyard of equity where early investors are being buried. The market has shifted, yes, but not in the way they promised. It has shifted from greed to fear. And as we peel back the layers, we find that for condo owners, the situation is not just bad, it is terminal. If the single-family home market is facing a correction, the Florida condominium market is a crime scene. While homeowners are bleeding equity, condo owners are facing total insolvency. We are witnessing a structural collapse, unlike anything in history, driven not by market sentiment, but by the law itself. The catalyst is the Structural Integrity Reserve Studies, or SIRS. Following the tragedy at Surfside, the state mandated that condo associations must fully fund their reserves for critical repairs. There is no opting out. There is no kicking the can down the road. While the recent passage of HB 913 extended the deadline to December 31st, 2025, do not be fooled. This is not a reprieve. It is merely a delay of execution. The financial guillotine is still falling. The bill has come due. Across the state, condo boards are slapping owners with special assessments ranging from $20,000 to over $100,000 per unit. For a retiree on a fixed income, this is an eviction notice disguised as a bill. They cannot pay, so they are forced to sell. But sell to whom? This is where the trap snaps shut. Fannie Mae has effectively blacklisted over 1,400 condo associations in Florida due to deferred maintenance and financial instability. This means traditional 30-year mortgages are impossible to get. The buyer pool has been decimated, reduced only to cash investors who demand vulture-like discounts. The result is a bloodbath in valuations. In Punta Gorda, condo values have crashed by 18.6% year over year. In Lee County, median prices are down 11%, while single-family homes tread water. Inventory in places like Collier County has exploded to a 12-month supply. If you own a condo in an older building in Florida right now, you don't own an asset. You own a liability that is rapidly becoming unsellable. But the trap has a second lock. Insurance. The narrative you are hearing about insurance stabilizing is a statistical lie designed to placate you. Yes, the average premium has leveled off at around $3,815 to $5,700 per year. And but stable does not mean affordable. Florida's insurance costs remain 3 to 4 times higher than the national average. And the fine print is getting worse. Citizens Property Insurance, the state's insurer of last resort, is aggressively shedding policies to private carriers, often at higher rates. More critically, a new mandate is taking effect. By 2027, every single policyholder with Citizens will be required to carry flood insurance, regardless of their flood zone. This is the escrow shock. You might have a fixed-rate mortgage, but your monthly payment is not fixed. Taxes and insurance are skyrocketing, pushing the total cost of ownership beyond the breaking point for the middle class. The monthly payment you budgeted for in 2021 no longer exists. You are trapped in a pincer movement. On one side, a condo regime demanding 6-figure assessments. On the other, an insurance market that treats your home like a liability. And as the costs rise, the value of your home falls. You are paying more every month to own something that is worth less every day. And the people who usually step in to stop the bleeding, the big institutional investors, they aren't coming to save you. They are already running for the exits. During the pandemic, Florida was not just a housing market, it was a casino. Hedge funds, algorithms, and amateur landlords flooded the state, buying up inventory, sight unseen. They told you this was the new normal. They told you the party would never end. But look around. The music has stopped. The smart money has already left the building. The latest data from the third quarter of 2025 reveals a mass institutional retreat. In Orlando, investor purchases have plummeted by 18% compared to last year. In the Miami and Fort Lauderdale metro, they are down between 14% and 21%. Jacksonville has seen a 7% drop. These are the entities that drove the price run-up. They have the best data in the world. They see the crash before you do. And right now they are not buying. In fact, many are quietly becoming net sellers, offloading toxicity onto unsuspecting retail buyers. With the investors gone, the floor has fallen out, revealing the rotting foundation underneath, the distressed market. While the national economy pretends to be resilient, Florida has quietly become the foreclosure capital of the United States. In October 2025, Florida recorded the highest foreclosure rate in the entire country, one filing for every 1,229 housing units. By November, the state led the nation with 2,819 new foreclosure starts in a single month. Zoom into Tampa. It isn't just a hotspot for tourism anymore. It is the #1 major metro area in America for foreclosure rates. The sunshine tax has been replaced by a distress tax. But the most tragic victims of this exodus are not the banks. They are the mom and pop investors, the regular people who bought into the Airbnb dream or the long-term rental fantasy. They are now trapped in a mathematical nightmare called negative leverage. The math simply no longer works. Borrowing costs are sitting above 6.5%, while capitalization rates, the return on investment, in Florida have compressed to just 3-4%. You are borrowing money at 6% to make 3%. That is not investing. That is hemorrhaging cash. To make matters worse, the rental market is softening. In Miami, rents have dropped 6.2% year over year. In Tampa, they are down 5.0%. Landlords are getting squeezed from both ends, skyrocketing insurance costs and falling rental income. Unable to sell at a profit and bleeding cash every month. Many sellers are choosing denial. They are pulling their homes off the market. In Miami, for every 100 new listings, 45 are currently being delisted, pulled off without selling. This creates a terrifying shadow inventory. These homes haven't disappeared. They are just hiding. They are waiting in the wings, accumulating debt, accumulating damage. And when they finally return to the market in 2026, forced by bankruptcy or probate, they will flood the supply even further, driving prices down in a second, more violent wave. The investors know this. The banks know this. And now the politicians are scrambling to stop it with a gamble that could change everything. With the economics of the state failing, the powers that be are preparing one final desperate Hail Mary. Governor Ron DeSantis has launched a crusade to eliminate property taxes entirely for primary residents. On paper, it sounds like the miracle cure for the affordability crisis. Imagine wiping out a $10,000 annual tax bill overnight. It is the kind of promise that wins elections. But in economics, there are no free lunches. There are only trade-offs. Eliminating property taxes creates a $25 billion black hole in local revenues. How do you fill a hole that big? Critics warn the only mathematical solution is to double the state sales tax, potentially driving it up to 12%. This political theater does not fix the market in 2026. It freezes it. Buyers will now sit on the sidelines, paralyzed, waiting for the November 2026 ballot to see if they get a tax break. Sellers will hold on, praying for a bailout that might never come. This policy uncertainty is the final nail in the coffin for transaction volume this year. So, where does this leave you? If you are looking to deploy capital in 2026, you must understand that Florida is no longer one market. It is a fractured landscape of crash zones and value traps. Zone 1, the crash zone, the southwest coast, Lee, Charlotte, Sarasota. This is a hard landing. Inventory here has already exceeded an 8-month supply. Prices are down double digits. This is where the bleeding is most severe, and it is where the falling knife is sharpest. Do not try to catch it yet. Zone 2, the illusion of resilience, the southeast, Miami, Broward, Palm Beach. Single-family homes here seem stable, with tight inventory around 5.5 months. But this stability is built on sand. The condo market in these same zip codes is collapsing under the weight of HOA assessments. As condo owners are forced to sell at a loss, that contagion will eventually seep into the broader market. My final verdict for 2026 is not optimistic. It is realistic. The base case scenario is a continuation of the grind. We expect statewide prices to drop another 3% to 5% as inventory peaks in Q2 2026. The market will not crash overnight. It will suffocate slowly under the weight of insurance and interest rates. But there is a bear case, a recession scenario. If the U.S. economy falters and unemployment rises, breaking the lock in effect, we could see a surge in forced selling that pushes inventory beyond 10 months. In that scenario, prices could collapse by another 15% to 20%. Florida is undergoing a rolling correction. It is a slow-motion repricing of paradise. For the last 5 years, fear of missing out, FOMO, drove this market. In 2026, the only emotion you should listen to is the fear of overpaying. The Phase 2 crash is real. The insurance crisis is structural, and the smart money has already left the table. If you are buying in 2026, you are not investing. You are gambling against the house. And in Florida, the house eventually always wins.